we have a far more intelligent person in joining the conversation than me, at least. Welcoming Mr. Dharmesh Kant, Head of Equity Research at Cholamandalam Securities. Dharmesh ji, a very warm good morning to you. Welcome on Market Today at Business Today Television. Tell us, how do you see sentiment on the large street, and what are you advising clients to do?
Yeah, good morning. I mean, still it's a tentative kind of an environment. I mean, sentiment-wise, people are not very sure how this is going to turn out. Heartbreaking and sad, the type of casualties which we have seen, and maybe it can go up likely. But markets are concerned about the financial impact, and financial impact will only happen if there is a supply disruption in the ecosystem which is there. So as of now, we don't see that happening. And I mean, latest update has been some truce kind of I mean, plea has been made by Hamas, so they want to come onto the table for talks. If that is the environment, then this is, I mean, it has been happening for many years, which is sad, but it's through that. And then, I mean, okay, into the earnings season, the expectation is very high, and aggressive buying may happen. As far as the entire environment is concerned about the people, it's the general sentiment is like this is a one-off thing, and historical bit of evidence just suggests that this is a good buying opportunity. It will not escalate to the extent that happened in the Russia-Ukraine kind of situation, when there was a total supply disruption after the COVID thing which has happened. So as long as that is not happening, it's fine. But yeah, too early to predict as of now whether this is the course of action which will follow. My own sense is that let's wait and watch for at least a couple of days more before jumping into a buying spree.
Right, Dharmesh bhai. Any picks that catch your attention at current levels? What are you advising clients? Anything that catches your fancy on the mid cap, small cap side, or even a blue chip that you feel should be a part of long-term portfolio via systematic purchases over a monthly basis?
I think systematic purchase over the monthly basis is the best option in the current scenario, and one has to now look up to large cap rather than mid cap and small cap because I think, see, there's nothing fundamentally wrong with the small cap or mid cap basket. The earnings have been good, the business is doing well. But the problem is the kind of valuation they are sitting on. There has been a huge run up in stock prices. Whosoever is worth his salt. So they have gone up significantly. But large cap do give us an opportunity to have a good buying or cherry picking out there. And there, I think if you blend the mix of growth opportunities as well as margin of safety and the consistency in the business performance over its multiple vectors or verticals, has been Reliance Industries. I mean, all its business division, be it oil to gas or Reliance Jio or retail, they all have been doing particularly well. And management has already cited the value unlocking to happen over next couple of years, and that is where the real juice is. Business have been growing well. I mean, all the verticals, especially the retail and geo vertical, has been clocking growth in excess of 15-16%. And we did a SOTP, that is sum of part of business valuation over a period of next 2 years, that is FY26, where we were looking into. And there the valuation of Reliance Industries comes out to be around 4,200. So at 2,300 or 2,200 kind of levels, it looks very attractive. Risk to reward ratio is again very attractive at current levels. If I mean, unfortunate playoff events turn out and market does go down further, so Reliance Industries is also correct. So it's a systematic accumulation kind of a zone. 1,900 to 1,800 is the lowest level which we are looking at Reliance Industries. Upside is 4,200 to be accumulated in every dip is what we have been recommending a client at this juncture.
Okay, absolutely. Good morning, Mr. Khan. This is Tanya joining in the conversation. Mr. Khan, we were talking about IT stocks yesterday, and the second quarter corporate earnings season is all set to begin tomorrow. We have TCS numbers, we have its buyback also, and then we have HCL Tech and Infi that will be reporting its numbers on 12th of October. So I want to understand from you that what should be the strategy ahead of the numbers, especially if we talk about these large cap IT names.
Yeah, good morning, Ms. Tanya. See, as far as earnings is concerned, I don't think there would be any surprise out there on the QT numbers. There would be largely muted to in line. I mean, it will be very much like what they did in Q1 numbers. So there won't be anything which will, on the numbers front, that is the P&L front, there won't be any surprises out there. If it happens, even it will be a surprise for the market. It will be a business as usual, and the problem out there is the discretionary spend will also see some more dip in this quarterly earnings when they update. What market is looking forward to is the type of deal wins they would be announcing going forward. If there is an upward trajectory or some visibility of silver lining out there, then that would be a great for IT companies, and maybe 1 or 2 more quarters of pain, and we are through this. So no major fireworks. I mean, single digit revenue and profitability growth, but single digit is what we are expecting in INR terms. I'm not talking about constant currency or the dollar terms. And it will be a muted guidance even this time around with the kind of yields which US is witnessing. I don't think the Indian IT companies are basically a consulting firm. They are on the software side. So there the business growth is very difficult to come by. It's a different story for AI, ML and generative AI kind of environment where things are still rosier out there. So with the kind of run up which we have seen, we have not recommending our clients to sell IT stocks as of now. We would like to see the at least the Infosys TCS management commentary and update on interview, and then we will take a call on that whether to accumulate more or to just stay invested. So no selling as of now, but hold to what you have already bought is what the recommendation is.
Okay, absolutely. So no major fireworks. That's the word coming in. But if we talk about mid-cap IT space, stocks like Birla Soft and KPIT, what are your thoughts there?
Tanya, what has happened in all the mid-cap IT space is it's more of a expectation run-up which has happened. All these companies have done some kind of a tie-up with their counterparts in US who are into generative AI. So the point here is the business has not come. It's only a tie-up which has happened, and over a period of time, 1 year, 2 year, when Indian IT firms, the mid-cap space, they develop that expertise and they have that manpower skill in place to cater to those software development. Numbers will start trickling in. But these tie-ups, I mean, going forward, that is what will be the world would be. So this will definitely provide a good opportunities for the revenue and the profitability traction. And that is where the build-up has been. So I don't think I mean, this financial year, you won't see any number playing out in a major way. Maybe FY25 onwards, you will see that trajectory of the growth which has been expected may start trickling in. So again, the advice is again same. I mean, Birlasoft or KPIT Technologies or KPIT is a different game from Birlasoft particularly. We are recommending them to. We have also recommended them to buy at earlier levels. So again, hold is the recommendation out there. So IT in hold is more of expectation play right now rather than meaningful business change happening, and which I don't see happening at least for this financial year. And cloud is still murkier in US, so whether this will actually happen in FY25.
Right. Dharmesh, you've shared your views on how IT is likely to perform during and post earnings. What are the bright sparks in terms of sectors and stocks specifically, if you can share, where you look at outperformance both in terms of financials as also in the market in the forthcoming earnings season?
As far as financials are concerned, outperformance is clearly spelled out for all the NBFC space or BFSI space. We have seen the kind of update they have given for their quarter two, be it private sector banks, public sector banks, or the NBFC. They all have been on a very sweet spot. Any growth in excess of 15 to 20% kind of an AUM growth they have been saying. And the good part is even the public sector banks have reported this time around a very good AUM growth when the festive season was pushed ahead. So like PNB came out with 14% kind of an AUM growth, Jammu and Kashmir Bank came out with 12%, Bank of Baroda was 16%. So they were earlier less than 10% kind of an AUM growth. So that space is really buzzing and rocking. At the same time, asset quality has been improving consistently, and now it becomes a very decent asset quality to look at. I mean, it's the best asset quality for last 10, 12 years. So this sector is definitely going to outperform. You have to do your cherry picking out there. I still believe that public sector banks will get related to the valuation multiples or nearby to the valuation multiples which private sector banks have. So there's a plenty of scope out there. Any correction out there should be bought into. And from there, Canara Bank and Bank of Baroda remains the top pick. Apart from financials, the other sectors which are likely to do well is automobiles. We have seen the numbers of all the two-wheelers. It's 20% kind of growth on an average for two-wheelers, three-wheelers, and passenger vehicle. Even commercial vehicle segment has reported 5% kind of a growth on a quarter for Q2 on a year-on-year basis. So that sector will be buzzing because input prices are already benign. So operating margins will be stable. At the same time, top line and profitability growth will be there, followed by defense and railway stocks. So they will continue to do well, they support good numbers. And they are, I mean, the businesses are lumpy, but overall trajectory is very good for them. So they would be posting good set of numbers. So what I am really worried about was IT, which I have already sounded. And the next is the pharma space, which I am not very particularly gung-ho about. I think the valuations are far ahead of their numbers which are likely to come. It will be 12 to 13% kind of an growth, but multiples have already risen to 25-30%. So that is where the challenge would be.
We'll stick to Dharmesh ji and take his view on mid caps and small caps. Dharmesh ji, very, very sharp rally, and somehow they remain unaffected both at the index level as also the ones that you see moving around in the high beta space, low ticket space. How do you see mid caps and small caps overcoming the problem that we see in the Mid East? Is this something to be worried about? How are SIP inflows into such funds that buy mid caps and small caps?
See, but what is the issue here is that mid cap and small cap are particularly largely illiquid kind of a basket. You can't, I mean, participation is low, and the people who venture into that after doing their due diligence are there for a long-term haul. It's not more of trading kind of an activity. I mean, large caps are largely where trading activity mainly takes place. So if somebody is buying into those names, so they are buying for 2 to 3 years kind of a perspective. And that is point number one. Point number two is most of these companies which we have seen a traction presently in like auto ancillary or some of the other segments of capital goods or railway infra, defense. These are particularly domestic centric companies. So I don't think I mean, even if the supply bottleneck problem happens out there, so the companies which are into chemical and agrochemical space, they are the ones which will be hit the most rather than the kind of stocks rally which we have seen in the mid and small cap basket. So they will largely remain insulated, even if this problem blows up to a larger extent. And the profitability and everything will be fine. The only worry point was, as we discussed, that it's more of a valuation kind of a thing. So some time correction may happen out there. I don't think price correction will happen to an extent where the damage is there. 10-15% kind of a correction can always happen. But let's not forget they have already run off 50-60% in this year since March. So I mean 10% just for a market correction is okay with them. At the same time, when we speak to HNIs, so they are, I mean, in fact, they are asking whether we should be adding on to more position in those space. So there we have recommended that let's see it for a while. Let's see the Q2 earnings and then we can jump into that. But capital goods space, auto ancillary space, particularly the EV side, these baskets are budging. I don't see anything negative happening out there.
Okay, absolutely. Mr. Kant, let's talk about Tata Steel as well. This stock will be in focus today, and it was among the top losers yesterday also. So Fitch Ratings, they have upgraded Tata Steel Limited's IDR from BB plus to BBB minus. And the rating agency has upgraded the rating of $1 billion notes also, which were issued by TSL's subsidiary ABJ Investment. So I want to, ask you about your thoughts on Tata Steel and where's the stock headed going forward?
See, Sana, the problem with Tata Steel is that it has multiple vectors in Europe, and there the problem lies. I mean, this rating upgrade news is definitely a positive for them, as the cost of funds will come down a bit because of this upgrade. But business-wise, the difficulties still remain where they are. I think Europe is going through already a slowdown, and their steel units out there won't be in a position to make a profitable business out there. I mean, metal consumption, the story is completely different when we look to domestic consumption in India. But internationally, even all the metal prices are almost flat to year till date. So there has not been any movement in the steel prices. In fact, steel prices in international market was down around 8% last week on a week-on-week basis. So that trouble is brewing, and it's continue to brew even more hot. So I don't think Tata Steel, business-wise, if you look at the consolidated or merged entity, the problem is getting resolved sooner. It will continue to face its own set of problems. If you are looking at steel companies, I mean, there are much better domestic plays. I mean, JSW still remains the topic out there, followed by even Steel Authority of India. It's seen a complete, turnaround, and the company
Right,
is
sir.
doing fairly well. Yeah.
About you, when we talk about these, defense counters, we have seen a stellar rally in the first half of the year. What about, now? I mean, the situation now, Mazgon Dock and Cochin Shipyard. What are your thoughts?
See, again, I mean, all the defense stocks are looking very attractive. Only the valuation metrics has changed for many of them. So the juice out there for immediate next 2 or 3 years kind of a scenario is not there in each one of them. But yeah, the story-wise things are intact. If you ask me between Majgaon Dock and Cochin Shipyard, I would still like to go with Majgaon Dock because the valuation comfort is far higher out there, and type of trajectory, order book trajectory which they are sitting on is more profitable than what the Cochin Shipyard is sitting on. So in the defense basket, HAL remains the topic, Hindustan Aeronautics, followed by, I mean, Majgaon Dock. Data Patterns is also very attractive. Keynes Technology is another stock. But these all ideas which we are discussing as of now, you can get a move for 5, 6, 10% in say 15, 20 days. But if you are holding on for say 2 to 3 years, they all are doublers from here. So this is how the things are placed. So traders can play with technical, levels. But investors, the firm advice is stay invested. There's no need to cash out from any of these defense technology. Even if, as a basket, if you are picking, you're better off.
Dharmesh, would you have a view on escorts?
Yeah, it's a positive view, but it's very expensive as of now compared to other counterparts. And as our colleague pointed out, it's in its own orbit of its own, and it's going extremely high. So one may enjoy the ride, the momentum with trading stop losses in place, and but it's not a fundamental buy recommendation from our deck. So what we have recommended is it's a fairly large auto basket. I mean, Hero Motocorp, TVS Motor, Eicher Motors, Maruti, M&M are the ones, and along with Tata Motors. These are the 6 stocks where a basket buy has been recommended by us, and that is where the focus is. And I am very sure the type of volume growth, these all companies will be giving around 10 to 12% kind of a volume growth on a year-on-year basis for next couple of years. And the margins will be stable because commodity prices have been benign, and I don't see them going anywhere far off too soon. So operating leverage, a good pricing power, new launches, everything is working out there. At the same time, the appetite for Indians to have more vehicles, multiple vehicles with the same families has been increasing quite large. So a good value buy. Scots is only one stock where valuation comfort is not there. But yeah, as a trading momentum play, it's always on. Just don't forget to keep your stop losses trailing out there.
Now, let's take a view from Dharmesh on Tata Motors.
Yes, please.
Yeah, thanks, sir. See, Tata Motors has what a turnaround.
Dharmesh.
Yeah, thanks. What a turnaround Tata Motors has seen from being a CV and domestic vehicle manufacturer to an international manufacturer. So, I mean, JLR is Tata Motors is basically a JLR play. Around 85% of its EBIT is coming through the JLR international sales. So, and that is where the traction is. And the latest update of the wholesale numbers, again 17% kind of a growth has been there on the volume wise. So that continues to, I mean, have a good inroad and traction in a market like Europe and US, where other brands are also present. So, I mean, remarkable job done out there. And still, I think the way the margins are shaping up and the electric vehicles, the pickup which we have seen in India, and some support from the CV side in the Indian side, because they have been losing their market share to Ashok Lane out there. If there is some traction out there, then I see Tata Motors heading towards 750 to 800, because margins have been improving. It's likely to improve more. I mean, 14% kind of a EBITDA margin they have given, more than 100 basis point of an uptick in Q1, which is likely to continue going forward. So a good fundamental value buy from our end for Tata Motors, and one year upside target is far higher, 20-25% kind of an upside gain should be there.